Good morning everyone, welcome to today's presentation. I'm not sure which day this will come out. It's being recorded on Tuesday morning. Alright, now we've had some heavy episodes the last few days, and they're getting heavy because we're getting very much closer to the total crash that will bring about the need for a total reset. Why do I know that? Because we're now in danger. We're now in the danger zone. As the Greg Mannarino market indicator said, we're 283, where 300 is crisis. Okay, extreme risk. And we are. Why? Because of bonds. Now, I went back through my past videos, and I want you to go back if you can and have a look at them. After 2 months ago, 2 months ago, we had bond shock, and I tried to bring you what was coming. 4 months ago, we had the bonds don't lie, and they're not lying, are they? And what have you seen in the last 2 or 3 months now with the bond yields? They're going up and up and up and up. They don't lie. Banks breaking. 8 months ago, I did a show. What do bonds break most? Banks. Why did Silicon Valley go? Why did Sovereign Bank go? Why did First National Republic go? Why did those 3 banks go in 2023? Because rates started to rise and they were sitting on an incredibly large bond portfolio. So they lost a lot of money. Who is sitting on bonds now, and how much have they lost? Just give you an example. I put into AI. A yield on a 1% bond rises to 4%. What is the loss on a 30-year bond? And it said 51.9%. Okay, 51.9% loss on a bond if yields rise. Now, what have Japanese bonds done? You've seen the charts. I've had Craig put them up for you. You've seen them. What have the Japanese bond yields done? They've risen from 0 to over 3. So a very similar rise from 1 to 4. So they've lost 51% over 30 years. So you have to bring that back depending on how many years are outstanding or how many years are still to be for the bond to be held. Can you see it? Please say you can see it. Because this is so important. The bond market, not the fund, not the clown, not the equity market, not Bitcoin. The bond market is the market which will determine everything over the next 2 or 3 years. Everything. I go back 8 months to one of my first presentations, Long Bond Crisis. And I invite you to watch that, and I'll ask Craig to link it. It's called Long Bond Crisis. It went back 8 months ago we made it. And between 1 minute 24 and 6 minutes 22 on that video, it explains an awful lot. And we also go into the Japanese carry trade. Now, the Japanese carry trade is going to have to start to unwind very, very soon now. Again, I warned you about it 8 months ago, 6 months ago, 3 months ago, 2 months ago. Why? Because I need to prepare you. I need to give you notice. It's no good telling you today what's happening tomorrow, is it? That's useless. On a macro structural view, you need to know what is coming, and I've tried to prepare. As I said to you, I started these videos way later than I saw what was coming, but I did it at a time when I thought, well, now I think most people could see it if it's explained clearly. Okay, so we are in a world now where the bond markets are almost self-destructing central banks, governments and banks, because those are the people who hold the bonds. Central banks and banks hold the bonds. Yes, investors, but they always get hurt and they don't change the economy. The central banks and the banks do change the economy. So I think anyone who is thinking can see we're in a bond crisis. Anyone who's thinking. And I said that 8 months ago. And I said US property falls were spreading, and they are. And I said the Japanese bond market needs to unwind the carry trade, and it is starting. Okay? So there was something required to ease that process, and then we talked about perhaps the use of XRP. But there's 10 trillion in bonds. So what is the Bank of Japan's bond? What's its value? The Bank of Japan holds 49% of Japanese bonds, government bonds. That's 4.9 trillion. So what are their losses? They're not the 51.9%, but there may be 20%. What's 21% of 4. It's a trillion. The Central Bank of Japan, the Bank of Japan, is sitting on a trillion of losses. Okay? Just bringing a bit of history into this, let me show you a clip now about bonds.
My, your luck, Mr.
Bond. James Bond.
Mr. Bond, I suppose you wouldn't care to, raise the limit?
I have no objections.
C'est pas possible, madame, c'est illégal, monsieur.
No.
C'est suivi, monsieur.
Looks like you're out to get me.
It's an idea at that. 8.
8 à la pompe. 9 à la banque.
Excuse me. Thank you. Andre, I must pass the shoe. Jean-Jacques, I hope you'll forgive me, but it's most important. Thank you.
Merci, monsieur, pour les employés.
And there you have it. And what does the lady say? Shall we raise the stakes, or shall we raise the limits? And what does she then say when Bond reacts? She says, looks like you're out to get me. Yes, the bond market is out to get you. Okay? It's not good. It's not good. Now, I wanted to find a really good piece then that I could link and show you, goodbye Mr. Fugly, and show you that this is being discussed at the very highest level by the very cleverest people, and yet no one sees it in relation to China. The Chinese bond market is colossal. It's the second largest government bond market in the world at 20 trillion. And it's going to go through the same process as Japan in the 1990s, where rates crashed. Chinese bonds at the moment, 10-year 1.74, 20-year 2.26, 30-year 2.24. In a year's time, those rates will be 4 and 5%, and the losses will be 10 trillion. That's just the way it's happening. I've also, so I found a piece, and I will link it. I'll ask Craig to link it. It's a piece by a guy called Michael Pettis, and I got Michael's name from China Update. And Michael, this is a fantastic piece, I promise you. Those who are really serious will watch this. It's over an hour, I'm afraid. But let me just give you the highlights. 8 minutes in, China had too much savings, too much production. That's what Japan had in the 80s. Hence savings. They had so much savings. What did they do? They chased property, didn't they? And what did they do with property? They took it up to a massive bubble and then it crashed. In fact, Chairman Xi made it crash in 2020 when he drew 3 red lines on the property market because he could see it was getting out of control. Sadly, he was a bit late. Sadly for China and sadly for Chinese investors, he was a bit late. He should have done that 3-4 years before. So 20 trillion has been lost. 20 trillion lost. So what do they then do? Well, they blew a bubble in property, and then the local governments have blown a bubble in infrastructure. There are massive railway stations in the mountains. They don't produce anything. They don't have a payback. They can't service the debt. They're just a white elephant. They're like the line in Saudi Arabia. A dream, a vision. Sadly, no payback and can't be completed. In China, they've completed them, which is even worse because you've actually committed even more money to the project that can't repay it, can't service its debt, can't repay it. So you've got another $20 trillion worth of local government investment vehicle. And how have they funded it? Selling bonds. Who to? Banks and the public. So you've now got 40 trillion of bonds in the Chinese market, 20 trillion issued by the government and 20 trillion issued by local governments. And the yield on those is going to start to rise soon, because look across the world. Look at Japan, look at America, look at UK, look at France, Germany. Look at all these countries, Germany particularly, a country you wouldn't expect the yield to, it's rising. People don't want the bonds. The risk is too high. So this piece by Michael Pettis, I think, is superb. He gets excess property spreads to excess infrastructure investment. We just talked about that. Bridges and trains to nowhere, etc. 11 to 15 minutes. This is a superb explanation. Okay? 11 to 15 minutes. It's a superb explanation how overinvestment leads to a collapse. And you can't see overinvestment anywhere more than you can see it in China. And it's not a criticism, it's just a fact. It's just a fact. The system encourages local governments to please the centre. So the local governments go out their way to please the centre. And as long as they can raise the money from the public, they will build stations that have no purpose. They will build airports that have no purpose. They will build anything to add to the country's growth, because the country wants 5% growth. It doesn't matter where, it just wants 5% growth. And it's got it in a property boom, and now it's got it in an infrastructure boom, but they both bust. So Michael Pettis compares it to the Soviet Union and Japan, which both went through the same cycles. What can I say? The bond markets are screaming to everyone, we're bust. We're a busted flush. We cannot repay these bonds. We cannot even service these bonds. And that's why the yields are rising, because no one wants the bonds, do they? They say, well, if you want to sell me a US government bond, I want 5%. I don't want 1%. And over the last 2-3 years, those rates have moved from 1 to 5. Australia have moved, UK, Germany, France, Canada. Doesn't matter where you look. All the rates are rising because no one wants the bonds. But the bonds are held by banks. Central banks and commercial banks hold bonds. And that's why in 2023 we saw the 3 US bank collapses, because they were holding bonds when the yield rose. What have we got now? We've got every single bank holding bonds as the yields rise. So they're losing money. And what that does is it squeezes liquidity, because not only have they got losses, which they won't recognise, they will simply say, no, we don't need to recognise those losses because we're holding the bonds to maturity. It doesn't matter. It still stops them lending because they've got losses in their books against those bonds. They don't have to recognise them, but they've got them. And the system won't let them create new liquidity. All right. So I hope you enjoyed that show. It is so crucial we understand the role of bonds over the next year or two. We've given you 4 presentations in the past. This is the big one. Please watch the links. Please understand what I'm trying to give you in terms of the picture as the bond market develops. Thank you very much. Cheers from Join the Dots.